Good evening, everyone, and welcome to the monthly Outlook webinar for UTI Mutual Fund on fixed income for the month of October 22. Hi, my name is Anurag Mittal. I'm the Deputy Head of Fixed Income, and I'll be sharing our views on what went on in October, what's the current market construct looking like, and what's our outlook ahead going forward. So without taking much time, I'll start with my presentation. So broadly, what really happens is from time to time, the factors which are critical for market, which drive market, keep on shifting, as different drivers become important at different points of time. If we recall, in November, December of last year, at the same time, we all were looking forward to the reopening of global economy, reopening of economic activity, and that was perhaps one of the biggest trigger points for market participants for taking a view on inflation as well as growth. If we again shift 5 to 6 months ahead, which is between April to June, the biggest factor then became the Russia-Ukraine war and its impact on commodities, and its impact on food and fertilizer prices, so on and so forth. If we again shift from June to this date, the focus has been on monetary policy normalization at a more aggressive level from the advanced economy central banks, most notably the Fed, as it went on to anchor inflationary expectations. So at different points of time, market has looked at different parameters to really assess view going forward. At this point of time, India's policy action in the near term is driven by one, how global rates are likely to pan out. Two, what's India's position and volatility on INR, which is Indian rupee for us. One of the basic assumptions behind this driver is that the broad economic activity in India is largely stable. We had the onset of festive season, which has been which has led to robust aggregate demand in the near term, as well as reopening of contact-intensive sectors, which has helped, whether we look at auto sales, whether we look at GST collection, whether we look at power consumption, etc. All these indicators point out towards a strong aggregate demand. In terms of even the withdrawal of southwest monsoon has helped in broad pickup in the travel, hospitality, and construction sectors. If we look at rural demand, whether we look at two-wheeler, three-wheeler, or tractor sales, on a YOY basis, they are looking quite strong, as well as now they have kind of overtaken pre-COVID levels. So that's also reflecting a reasonably strong rural activity. If you look at the PMI indicators, so while on the services PMI, we have moved from 54.3 to 55.1. Even on the manufacturing side, although we have moved from 57.3 to 56.8, it's still looking quite strong as it's over 50. So broadly, as long as the domestic demand drivers are in place, that's why I said that the near-term driver for our policy action and bond market is how globally rates are likely to pan out. In terms of global interest rates, given that the predictability of inflation has been slightly erratic in the last 18 to 24 months due to various supply side and geopolitical factors, central banks are largely looking at spot inflation rather than just looking at forward-looking inflation. So as of now, global spot inflation is still on the higher side due to elevated commodity prices, as well as a very tight labor market. While the labor market may persist in the near term, the momentum for global growth is slowing in the near term and is likely to remain weak in the future. However, what's happening at the same time is because of the wide gap between central banks' previous forecast and the actual outturn of inflation, they are slightly on the conservative side. And right now, they are determined to anchor inflationary expectations, which at a margin increase the risk of early recession as well as inadvertent policy accidents, as we are also looking at one of the highest interest rates in the last 30, 40 years, as well as is coming on the back of a declining liquidity from dollar perspective. And more importantly, and I will show in the upcoming slides, it's not just the level of change. So if you look at the level of change in the bond yields, it's not very material, at least in the last 2-3 months. It's not just the level of bond yields, but it's the daily volatility which has increased the probability of market stress, and hence which we call policy accidents. I'll move on to the next slide. So if we look at for the month of October, broadly this chart talks about how policy rates for major economies have evolved, as well as month-on-month change in inflation and the absolute level of inflation. If we look at the headline levels of inflation and for US, UK, or Eurozone, we find that for most of the major economies, inflation is still at a uncomfortable side. And even if we look at the month-on-month change, it's not materially going down. So the sequential decline in momentum of this month-on-month inflation is something at which central banks will be very keenly looking at. In terms of major change, and mind you, this is for the month of October, amongst the G10 central banks, we had rate hikes from major 4 central banks. So the Bank of Canada hiked its policy rate by 50 basis to 375. The Reserve Bank of New Zealand also hiked by 50 basis to take its policy rates to a 7-year high. The ECB hiked its third major policy rate hike in this monetary cycle at again 75 basis points, while the Reserve Bank of Australia hiked by 25 basis. So it wanted to assess the impact of previous rate actions on its monetary policy. So that was the first sign of a major central bank taking a step back and looking at how the previous policy hikes have really affected the economy. So probably we will see as we go along more central banks looking again kind of slowing down the pace of hikes and taking the impact and then moving on. So that uncertainty window slightly increases both for the market participants as well as the central banks. A not so fun trivia: the total rate hikes in the G10 central banks in this monetary policy cycle till October 22 is about 2,050 basis points. So that's the kind of change in inflation expectations and the kind of major policy rate actions which many of the G10 advanced economy central banks have taken. I'll move on to the next slide. So this slide largely reflects the change in 1 month in terms of basis points for the 10-year sovereign bond yield. So like I said, apart from UK, which of course had a very large volatility due to changes in the budget. So first they announced a budget which was slightly on the fiscal stimulus, driving the fiscal stimulus, which they had to turn back as they found a very adverse reaction on the market. But broadly, as we can see on the 1 month change, it's not the absolute change which is really affecting the market. As we can see from March 22 to June 22, for example, for the US, we also saw a 60 to 70 basis points change in interest rates. But it is this move in this last 3 months, which I will show in my one of my subsequent slides, which has really kind of led to that stress in the market, as well as that increase the probability of policy accidents because of the very high volatility. So I think that's something which we would I think we can note. So even if you look at Germany moved from 0.55 to 1.12 during the same period from March to May 22. But it is the last 3-4 months which are the major stress points for much of the bond market. If you look at the commodity index, largely it is flat from September to October, so it's much below the June 22 highs that it made. If you look at the currency performance, so this is, I think, like I was mentioning in the introduction, one of the major drivers for more aggressive action by emerging market central banks. So mind you, the emerging market central banks are not facing very high deviation of inflation from their targets. It's this currency performance against dollar, it's this high volatility of their currency against dollar, which has led some of them to preempt their policy action, as well as to keep rates on a more restrictive territory to maintain a slightly higher real rate, at least on a forward-looking basis. So mind you, it's not that, for example, for India, it's not just, although we say that drivers of inflation are different, and again, which I will discuss in the subsequent slides, but when we are not close to our inflation target, when any economy is running a high current account deficit like India has been running, it's critical that at least there is a perception of macro stability. There's a perception of reasonably high real rates, and due to which, despite the deviation not very large as what the US and Eurozone are facing, still India had to be slightly preemptive in their policy actions. Coming to India trends, so these three lines largely signify, so this orange line signifies the yield curve, the sovereign yield curve as on 31st March. The light blue line signifies the yield curve as on 30th September 22, and the dark blue line signifies the yield curve as on 31st October 22. So one of the interesting things which really come out from March to October or September is, if you look at the shape of the yield curve in March, it was reasonably steep, where 3-month or a 1-year T-bill was trading around 4.5, and your 10-year GSEC was trading around 7%. And if you compare the current shape of the yield curve, 1-year T-bill was somewhere trading 670 to 680, whereas the 10-year GSEC was trading somewhere close to 7.5. So what's the reason why yield curve has flattened? So whenever we see a change in monetary policy cycle, because the short end is usually anchored to the overnight rate, so whenever the overnight rate starts to change, is the short end which starts to get impacted the most in terms of basis points. The long end, since it's largely building in some expectations of rate changes, that's why long end does not react very meaningfully to whenever there is a change in the monetary policy cycle. If we look at this, we also try to show more quantitatively. So if we look at the 1-year T-bill rate, it's moved from 445 to 687. If we look at the 3-year GSEC rate, it's moved from 584 to 7.19, whereas at the same time, the 10-year GSEC has moved from 684 to 745. Apart from the change in the monetary policy cycle, one of the reasons for this flattening of the yield curve is also this liquidity surplus turning into deficit mode in October. As we know, in the last 1 year, we have seen the usual currency leakage, which happens every year. Apart from that, there has also been RBI intervention because of the rupee dollar volatility, and that's also led to, so whenever RBI sells dollars, it sucks out rupee liquidity from the system, and that also leads to liquidity declining from its levels. Uh, Going forward, we expect liquidity to largely remain in deficit. I mean, there could be some days where liquidity is surplus due to some seasonal factors, but broadly, November to March is a busy season for India, and usually we see currency in circulation increasing, which leads to a reduction from banking system liquidity. We are also likely to see advanced tax outflows around 15th of December, as well as a large advanced tax outflow during 15th of March. And this is also a time when government, to adhere to its fiscal deficit, it starts to subdue its spending. So the government cash balances increase, and the banking system liquidity starts to kind of go down. So these, largely because of these three reasons, we expect liquidity to remain largely in the deficit zone going forward, unless and until we see some very heavy FX flows, which leads to RBI intervention on the other side, or there is some policy action. But largely, we expect liquidity to remain in deficit mode, and hence there could be some pressure on the short end of the yield curve. The second reason for this, flattening of the yield curve, if we look at the credit growth and deposit growth YOY numbers, in we see since March of 2022. The credit growth has started to pick up, and it's going almost to 18%. So like we said in the introduction of the session, the domestic economic activity remains quite robust, and hence we are seeing credit growth across individual as well as on the corporate side. Whereas the deposit growth has been slightly slow to catch up on the credit. Possibly one of the reasons was low nominal rates, and as the banks have started to increase their deposit rates, probably at some point of time the deposit growth would also start to catch up. But just to service this very high credit growth, banks had to raise their funds through issuance of certificate of deposits or CDs. If you just look at last year around October, third week of October 22, the total outstanding CD was around 57,300 crores. If we look at the same time this year, which is around 21st October 22, the total outstanding CD was somewhere close to 2.4 lakh crores. So we saw a delta of close to 1.8 lakh crores in the issuance of CDs, which also explains why we are seeing the flattening trend that we saw. The third reason for the long end. So one of the interesting things, if you would look at the shape of this yield curve, is this 30-year GSEC. So there is largely any spread between 10 to 30 or even 10 to 40-year GSEC. In a period of high inflation, ideally, there should be a high term premium as well. Why it's not there? The reason being on the SDL issuance side. So if we look at the SDL issuances from 1st of April, which is the start of this fiscal year, to 31st October 22, in 2020, the actual issuance of SDLs or state bonds was 55,000 crores higher than the announced by various states. If we look at 2021, the issuance was 62,000 crores lower than the announcement. That is, if market participants were expecting 4.3 lakh crores, the actual issuance was only 3.7 lakh crores. And if we look at 2022, the actual issuance has been 1.3 lakh crores lower than the announcements by state themselves. So it's not market participants' expectation, it's the announcement by the states themselves and the actual issuance gap. So what really it's led to is, so a lot of long only investors such as insurance, pension funds, provident funds, etc., they are required to hold a certain tenor of government bonds or SDLs as part of their statutory obligations. When they don't get a certain quantity of state loans, sometimes they have to buy long dated government bonds, and that's what really led to this high demand on the long end side, and that's why we are seeing uh, this flattening of the yield curve. So till this anomaly corrects, we could see a slightly flatter yield curve as we are seeing currently. On the inflation side, largely, CPI inflation rose from 7% to 7.41% in September, as food inflation increased from 7.6% YOY in August to 8.4% in September, largely driven by higher vegetable and cereal prices. Core inflation moved from 6.1 to 6.3. I think so. Like I said, why this is slightly critical, that especially on how we expect RBI action to pan out, is as we can see the blue line, the blue bars in this chart. This largely signifies what's RBI expecting from inflation going ahead. So as we can see, RBI is largely expecting inflation to average around 5% in Q1 of FY24. If you look at core inflation, if you look at 2021, so I removed the COVID year, and if you look at from 2021 January to this date, core inflation has averaged around 6%. Some of the core inflation is also because of supply chain disruptions, which are likely to ease out. So assuming core inflation starts to average somewhere between 5 to 5.5, it's the reduction in food inflation apart from the base effect. So this 5% is predicated, one, on reduction in food inflation. Second, the base effect. So even if, let's say, prices were not to go up, and that is, they would largely to remain same in absolute terms, we could see inflation closely to RBI's level. So I think it's the food inflation which could remain a key driver of our inflation view going ahead. And upside risk to food inflation largely emanate from cereal prices, because globally, because of some extreme weather patterns, as well as because of Russia-Ukraine war, we have seen prices of rice as well as wheat going up, as well, and locally, because of slightly erratic monsoon, we have seen excessive rains affecting fruits and vegetable crops. So what will be critical to watch out for is how cereal prices and fruit and vegetable prices behave going ahead, and that's largely which will determine this 5% inflation forecast, and henceforth RBI's reaction function as well. So this slide largely describes the trade data. So as you can see, we have tried to look at the exports, oil exports, non-oil exports, and imports, and so on and so forth. So as we see, if we compare the 2022 to 2023, our trade balance has almost doubled from 76 billion deficit to 150 billion deficit. Key reason is, of course, rise in crude prices. If we look at our oil import, which was about $70 billion in April to September, has now gone to $115 billion. And if we look at the non-oil imports as well, it's moved from 205 to 264 as economic activity has started to pick up, which typically increases the import intensity for our economy. Going forward, if we look at the average of this trade balance and henceforth the BOP, so far we have averaged around 25 billion per month, with crude prices stabilizing now and the usual financial year seasonality. So for India, what's interesting is in Jan to March period, our non-oil exports start to pick up. So this 25 billion probably we have seen the peak in our trade balance and henceforth current account balance. So probably by year end, this should normalize. And what we are expecting and what even RBI is expecting is about a 3.4% current account deficit, which we think largely can be somewhere between 3.4 to 3.6. So we are also not expecting a very major slippage from RBI's forecast. On the fiscal side, if we look at the gross tax collections, they have been growing at about 18% YOY in 1H FY23, and they have already reached 50% of full year FY23 budgeted target. So this is much higher than the usual run rate that we see in gross tax collections. Even if you look at the monthly average GST collections, which is somewhere close to 1.49 trillion, which is the 12 to 13% higher than the budgeted target. So overall, from a tax collection side, we are quite comfortable. Having said that, we are also experiencing some shortage from RBI dividend in terms of the actual versus budgeted, as well as from dividends from other PSUs and some disinvestment proceeds. The second concerning aspect on fiscal is the increase in subsidies on food, oil, as well as LPG because of with oil prices going up. The fertilizer prices have gone up meaningfully as well, and government has to provide a subsidy in fertilizers in excess of 1 lakh crores, more than the budgeted amount, as well as because of extension of free food grain program, which is the Pradhan Mantri Garib Kalyan Yojana. Even the food subsidy is expected to be more than 80,000 crores than budgeted. LPG subsidy so far is expected somewhere between 20 to 30,000 crores, assuming no major change in oil prices. However, we broadly expect central government fiscal deficit to be 6.4%, which is their budgeted target, as fiscal slippage could be neutralized by larger than expected. One, tax collections, as I described, and second is the nominal GDP. Mind you, the government had estimated nominal GDP or budgeted nominal GDP to be at 11.1% for FY23. The actual nominal GDP could be much higher than the budgeted number because of a high GDP deflator, because of high WPI inflation. The second point, so even if, let's say, the fiscal deficit is slightly higher than the budgeted amount, government has been quite conservative in the financing of its fiscal deficit through national small saving. So government has assumed a lower financing through national small saving fund compared to the previous year. And if you look at the current run rate of small saving, it's running slightly higher than the previous year. So one, government can tap into national small saving rather than coming out market borrowing. The second point, government is also running a significantly high cash balance. So right now it's running cash balance in excess of 1 lakh crores as per WSS data. And like I said in the beginning, when I was explaining liquidity, usually at this point of time, government starts to slow down discretionary spending, and hence we expect that government can also use its cash balance apart from small savings if it faces any fiscal challenges. So as I had discussed in my very first slide, it's not just the absolute change in bond yields or in market, which matters is the volatility. And one of the ways to look at volatility is what's the average move over a period of time, and what's the daily move that we are experiencing. So let's say, just for hypothetically, a 10-year which was trading at 2.8 moves to 3%. That's 20 basis daily change. What we have tried to look at is this orange line signifies the average move in US 10-year from January 21. And mind you, just to be slightly more consistent, what we have looked at is the absolute change. So let's say, because we are just trying to look at volatility. So even if, let's say, 10-year moved minus 5 basis points on a day, what we have tried to look at is the absolute number, just to assess the kind of changes that we are looking at. So as you can see, since June 22, the average the daily change that we are looking at is meaningfully higher in terms of magnitude compared to the average in the last 2 years. So if you look at the same period last year between July to September 21, the change from the orange line is slightly on the shorter side, and if you look at the current change, it's much bigger. So that shows a market which is quite volatile, a market which is looking to pivot and looking at the Fed pivot, but unfortunately, the data was not supporting that market. So, and hence, whenever we see this kind of a volatility, it also leads to some stress getting built up. It also leads to sometimes illiquidity. It also increases the chances of, like I said, accidents when we see this kind of moves in benchmark bonds, because this also ultimately gets reflected in corporate bonds. It also gets reflected in high yield corporate bonds as well. So I think that's something which policymakers are looking at. So and that's why one of the reasons was that probably central banks will not be able to hike very, very aggressively if we continue to see this kind of volatility going ahead as well. The second, one question which sometimes keeps on coming in investors' mind is if Fed were to hike, let's say the current market pricing expectation from the Fed is about 75 basis points. If Fed continues towards that path, India will have to hike in a similar manner? We think maybe not. If we look at the drivers of inflation in India compared to the US, if we compare the 2021 inflation to 2022, the US inflation is quite broad-based. So this orange bar signifies the food inflation, this blue bar signifies the fuel inflation, and this light blue signifies the core inflation. If we look at the both food inflation or fuel or core, US is experiencing a much broad-based inflation. If we look at Eurozone at the same time, it's largely the impact of food and fuel, which is largely supply side. If we look at Indian inflation at the same time, it's not very broad-based. One of the major drivers of India's inflation is food inflation. So if we look at the orange bar of 2021 compared to 2022, it's largely the food inflation which has led to this delta, which is broadly a supply side shock. And if we look at this, the right-hand side chart, which is the FAO food index, YOY, food prices have already started to come down. So assuming food prices don't go up materially and core inflation remains largely range bound, I think it should help inflation move towards RBI's 5% target. And hence, probably RBI does not need to hike as aggressively as some of the advanced economy central banks need to hike. The converse is also true. So just because, let's say tomorrow we see chances of high recession increasing, and let's say Fed starts to pivot and Fed at some point of time starts to, let's say, slow down, pause, or even cut interest rates, and that's going very future in ahead, India might not see the same path. So like I said, the domestic economic activity is quite resilient. So RBI does not have the same reason as probably a US or Eurozone to step back. Secondly, our actual inflation target is 4%. So it will take some time for that inflation, to reach that 4%, and hence probably RBI does not have that kind of very fast monetary transmission, which can lead to RBI just following Fed in lockstep. So when Fed is hiking aggressively, RBI does not have to hike as aggressively. When Fed starts to pause, uh, maybe RBI will also pause at some point of time. But even if Fed were to pivot, it will take some time and some more confidence for RBI to pivot. But does that mean that if inflation does not reach 4% in India, is it a very big cause of concern? We don't think that, because globally, I think central banks and market participants understand that a large part of this inflation is supply side driven, and it's largely beyond central bank control. So the 2% inflation that we are used to seeing in the advanced economies, it will take some time for us to see that inflation going back to 2% in the advanced economies. And hence, it doesn't mean that India also has to reach 4% in a very short span of time. Just like global market participants will be more patient with developed markets reaching to 2%, same way we can also take some time to reach to 4% level. The second point, it's usually it's understood, or it's kind of it is a perception that India is probably decoupled from the world. If you look at just gross exports as percentage of GDP, they're still more than 20%, right? And because of this aggressive monetary action, when there's a slowdown or a recession in the global economy, it creates growth headwinds for India as well. So whenever so we don't. That's also one of the reasons we think that India cannot follow developed market central banks in lockstep in hiking rates very aggressively. The third reason why we think even the advanced economies cannot keep their nominal interest rates at a very high level is if you look at their debt to GDP. If you look at the government debt to GDP in 1980, for example, for the US, it was just 37%, which is now close to 120%. If we look at Eurozone, since Eurozone was not created in 1980, but so the first reference point where we are taking is 2008. If you look at even the Eurozone, this debt has gone up just from 2008, 70% to 96%. Currently, whether we look at UK, the story is the same. So the leverage government balance sheets make it really difficult for advanced economies to keep extremely high policy rates for longer. So we are not saying that they can't go up, but even if they go up, they can't remain at those high levels for a very long period of time. The other question which comes up is that, okay, assuming that maybe central banks in the developed markets will hike aggressively, but if RBI is not expected to hike very aggressively, should I how are the bond valuations looking? So so we have taken the spread between the 10-year government bond and the 1-month OIS. So why we have taken 1-month OIS and not repo or reverse repo? So as you know, in the last 4 or 5 years, liquidity has moved from negative to positive and positive negative, and that kind of distorts the policy rate. So there have been times where the reverse repo rate has been irrelevant and repo rate has been irrelevant because liquidity was surplus, hence the system was operating on reverse repo rate. So to make it more reflective of the overnight rate, we have taken 1-month OIS, which is largely a reflection of 1-month compounding of the expected MIBOR rate. So if we look at the current spread, is largely in line with the historical spread between 10-year GSEC to 1-month OIS. 1-month OIS on its 10-year average has been largely around 105 basis points. So we are largely there, and so that's why. So the benefit that the 10-year segment had to see because of the curve flattening, which we discussed, which was liquidity reducing from surplus to deficit, high credit growth, leading to issuance of certificate of deposits, and lower STL issuance. It's largely seen that. Does that mean that it will move up significantly if there are rate hikes? So we think that some of the rate hikes are already priced in on the yield curve. So for example, at UTI, our base case is a terminal repo rate of around 6.5 going forward, which is largely priced in on the short to medium part of the curve. Although in the near term, we might see some intermittent volatility because of global factors or currency volatility or RBI intervention. Broadly, we think if we look at the shape of the yield curve, it's largely getting priced in. So, for example, if we look at even the government bonds rate, even if you assume that repo can go somewhere close to 6.5, and these levels are as of 31st October 22. So the current levels have changed somewhat, but broadly, if we consider these spreads, the 3-year GSEC at 7.19 or 5-year GSEC at 7.37 as of October, these levels are slightly lower right now. But broadly, these spreads are quite attractive from a long-term allocation standpoint. So to summarize, the current volatility in the bond market, and especially on the short end of the yield curve, is due to extreme risk aversion in a very high volatile environment. For some amount of time, we have been running duration at the lower end of the spectrum. So when a large amount of market participants in August and September were expecting a Fed pivot and hence running duration on the higher side, at that point of time, we were running duration at slightly on the lower side because we were not sure whether the time was right for the Fed to kind of indicate that the war on inflation has been largely won. Because one of the problems that the Fed is facing is Fed is also looking at financial conditions. So the moment Fed gives an indication that, yes, it has pivoted or it is looking to pause at some point of time, usually it's kind of succeeded by a bond market and even an equity market rally. And that kind of leads to a ease in financial conditions, which kind of defeats the purpose for the Fed. So Fed is kind of in a catch-22 situation right now that, yes, at some point of time, it will pause, but it cannot give a very strong forward guidance on that pause, because the moment the Fed gives forward guidance on the pause, it usually leads to ease of financial conditions, which it wants to avoid because it wants to anchor those inflationary expectations. And hence we are likely to see a more volatile environment in the short term till we see at least the data on our side. So since we are not getting that forward guidance from the Fed, which is quite understandable, I think the market at some point of time will become data dependent. We already had a release of US CPI, which was slightly lower than market expectations, and that which was the first, I would say, positive surprise in a very long time. And hence, we saw some rally in bonds as well as emerging market currencies across the world. Probably, if this inflation data were to continue to surprise on the positive, which is the actual inflation is lower or similar to market expectations, I think that will show that decline in that momentum of inflation, which market participants will take slightly positive. So from the current allocation standpoint, so like we said, the current so we are expecting RBI to probably pause around the terminal repo 6.5. This takes into account average inflation somewhere close to 5.25 to 5.5 for FY24, and hence assuming a 80 to 100 basis points real rate on that, a 6.5 sounds like a fairly conservative estimate. A large part of it it's priced in the short end of the yield curve, which is the 1 to 5 year, and hence we are recommending that investors who can tolerate some intermittent volatility, but who have a 6 to 12 month investment horizon, they can start considering allocation to money market and low duration strategies. And investors who have a 2 year and beyond horizon can look at actively managed high quality short term or corporate bond strategies. Uh, Finally, investors with more than 3 years of investment horizon may consider a staggered allocation towards roll down strategies to lock in the current high nominal levels. So broadly, that was the takeaway that we wanted to talk about. Uh, Now we can, thanks a lot for listening to the webinar. And now we can open up for questions, please.
Thank you, Anurag, for sharing your insights on the market. Participants are requested to share your questions on the link shared with you. We'll wait for a few seconds for questions to queue up. Okay, so we have this question, Anurag. In the short end segment, apart from policy action, do you see abundant supply of CDs on account of surplus liquidity and high credit growth? Will this put more pressure on the short end of the yield curve?
Thanks for the question, Sonal. So two things. One, so like we discussed, the system is experiencing high credit growth, and given that banks have just started to increase their deposit rates, it will take some time for retail deposits to help fund that credit growth, and hence in the near term, banks might have to issue more certificate of deposits, and that could keep some supply pressure on the short end. But having said that, it's also largely, I think, priced in by the market. Yes, in the near term, can yields go up somewhat? Yes, they can. But if you look at the current spread, right? I mean, if you look at the current overnight rate, it's somewhere close to 6%. And if you look at the 1 year CD rate, it's somewhere close to between 7.5 to 760. So you're already getting a 150 basis kind of a spread between your overnight to 1 year CD, or even if you look at the 6 month CD, which is, let's say, of May or June, that's trading somewhere close to 730, 740. So even if, let's say, you were to move towards 6/4 to 6.5 kind of policy rate, the current levels are compensating you somewhat for this kind of volatility. So if you can tolerate this volatility, I think the current levels are attractive. But yes, in the near term, short end of the yield curve could remain slightly volatile. Also, Jan to March is a busy season for banks, and hence, if credit growth continues to follow the same pace, we can, see some amount of volatility in the short end of the yield curve.
Thanks, Anurag. The next question is, with the widened current account deficit, fiscal deficit, and CPI expectations still above MPC target band, where do you see policy rate to peak? Also, is it advisable now to be in the shorter end of the curve and move money to longer duration funds, or maybe strategies like medium-term credit risk strategies in a staggered manner to gain from the higher accruals?
Thanks for the question. So like we said, we are expecting inflation to average somewhere between 5/4 to 5.5 in FY24, assuming no major changes in commodity and food prices. If that is actually the case, assuming a 80 to 100 basis real rate, which is the preferred RBI's real rate framework as of now, we expect policy rates to peak around 6.5. We do not think that RBI will have to hike very aggressively with the Fed, as drivers of inflation are very different in India compared to the US. So with that in mind, so like I said, the long end of the yield curve is largely at its fair valuation for the last 10 years. So usually long end, it makes sense to invest when someone is expecting a capital gain. Uh, Usually, when do you see a capital gain? You see capital gain when you are at the end of the rate cut cycle, rate hike cycle, sorry, and you one is expecting rate cuts in the near future. So we are not at the end of rate hike cycle. We have still some way to go. Second, till commodity prices and food prices meaningfully change, probably we are not looking rate cuts in the very near term. So we believe is the short to medium end of the curve, which is the 3 months to, let's say, depending on the investment horizon, the 3 to 6 months or even up to 5 years part of the curve, which provides that kind of cushion, which provides that kind of accrual, which sufficiently compensates right as things stand for now. So from a valuation standpoint, it's I would say the 3 to 5 year segment or the 1 to 2 year segment, 1 to 5 year segment, which is looking more attractive from a valuation perspective than the long end.
Thanks. On a follow-up question, what would be your advice to the investors in gilt strategies?
So investors who are already investing or invested in gilt strategies, so like I said, we do not expect very aggressive RBI action. Secondly, whenever an investor is invested in gilt strategy, it's assuming that you have invested with a 3-year horizon in mind. So probably, so whatever the time horizon, at least I would say at least in the next 6 to 12 months, like I said, we do not expect a very material change in policy rates. And hence, from a risk reward standpoint, so there could be some intermittent volatility, but largely we do not expect any material or a meaningful change in levels. From a new allocation standpoint, so again, so like I said, one should look at gilt strategies with a minimum 3 to 5 year horizon. And in a minimum 3 to 5 year horizon, I think it's really pointless to look at very near term interest rate drivers. One should invest in an actively managed gilt fund, unless and until one is taking a directional call. But one should invest in an actively managed gilt fund and let the fund manager, kind of construct the portfolio as his or her duration view and the market construct from time to time. So, like I said in at the beginning of the call, last year same time we were discussing about COVID reopening. 6 months back we were discussing Russia, Ukraine, and its impact on commodities, and today we are discussing how the strong dollar is leading to different central bank reaction functions. So market parameters keep on changing. I think as long as one is clear that one is tolerant of high volatility, which is there in gilt funds, because many of them at different points of time can run high duration. Secondly, since gilt funds consist of government bonds which are actively traded, the mark-to-market volatility that you see in gilt funds can typically be higher in credit fund than, let's say, a credit fund, which is not very liquid, and hence the price discovery is not perfectly efficient. So as long as one is clear of the risk reward, one can look at gilt fund, but from a 3 to 5 year perspective, and it should only be a small allocation of one's portfolio because it's highly volatile. One should not look to invest more than 20-25% of their allocation in gilt funds.
Very well said. Moving on to the next question, there has been no confusions in the minds of investors when they look a plethora of investment options, like there are target maturity index linked products, and also there are many open-ended debt funds which are following roll-down strategies. So what exactly are the advantages and disadvantages of these two strategies? Would you like to throw some light on this?
Sure. So a roll down strategy is typically run in an open-ended debt fund, where the fund manager constructs a portfolio of a certain maturity and lets the maturity decline till it reaches the target date. So, for example, just as an illustration, uh, let's say a fund is following a 3-year roll down maturity. So the fund starts with largely the 3-year maturity. At the end of year one, the fund is remaining with a 2-year maturity. At the end of year two, the fund is with a 1-year remaining maturity. At the end of year three, the fund is closer to 0 years of maturity. So that's how the roll down strategy of a fund happens. In a target maturity index fund, largely it's the same strategy, but the fund has to follow the index in a target maturity index fund, whereas in a roll down strategy, there is a certain flexibility in terms of security selection, in terms of maturity for the fund. So to give an example, let's say in the same, just to follow through or to continue with the previous example which I said. So let's say you are investing in a 3-year target maturity index fund. So typically, you would be that fund would be mirroring the index of a 3-year target maturity, where the securities, and the maturity bands will largely be predefined, and the scheme can only invest in those securities. So whenever a large or any inflow comes, the fund has to invest in those securities in the same proportion. And when any outflow happens, the fund has to sell those securities in the proportion of the index largely. So whereas in a roll down strategy, in an open-ended fund, there is a certain flexibility to the fund manager that he or she may decide to buy securities which may or may not be part of index. The fund can also invest. So let's say in the same example, so let's say it's a 3-year roll down strategy. In case of any large inflows or outflows, the fund necessarily doesn't have to buy the exact maturity of 3 years. So let's say if the fund is buying a 2.5 and 3.5, it's still leading to a 3-year maturity. Whereas in an index fund, you cannot exceed the maturity date of the index. So in terms of advantages and disadvantages, in terms of advantage of an index fund, there is better predictability in terms of the portfolio, because since you know the index methodology, you know beforehand that typically the fund is restricted to buy only such and such securities which fulfill the criteria of the index. And hence, you know that, okay, what to expect when you are entering into an index fund. In an open-ended roll-down fund, the fund manager has that flexibility. So the advantage of a roll-down in this aspect is let's say it's a non-GSEC or a non-SDL portfolio. You are not outsourcing your credit process. You are not outsourcing your credit risk to an index. So the fund manager, let's say it works both ways. So let's say a fund manager is, let's say, somewhat bearish on a particular sector or on a particular issuer. The fund manager can choose to remove that security or that sector wholly from the fund in case it's a roll down strategy. Whereas in an index, you are tied to the index at all points of time. The second, different, I would say that the fund manager has that flexibility to buy or sell in case of large inflows, outflows. So like I said, since there is no restriction on the maturity date, and there is no restriction on the number of issuers, the fund, but they can buy fund, you have to buy within the same. So in case of a large inflow or outflow, index fund can also have some a higher impact cost because it has to align to an index at all points of time. But of course, like I said, the advantage is the investors know that what the fund is likely to buy because they know the index characteristics. So largely, it's the flexibility in a open-ended roll-down strategy compared to uh, a certain parameter that the fund always has to adhere to in an index. So largely, I would say, uh, from a investor standpoint, I think the investor needs to firstly uh, understand that, okay, they are looking a target maturity, and if they are investing whether in a roll down or a target maturity index fund, they should look to invest with us with the full time horizon of the roll down or the target maturity strategy. So if you are investing in a 5 year roll down or a target maturity, one should look to complete the whole 5 years and stay invested with the fund to get that full benefit. The second difference, again, one can be taken as an advantage or disadvantage. In terms of an index fund, once the target maturity is completed, the fund extinguishes and the money is refunded if you are holding on to the fund till maturity of the index fund. In case of a roll down fund, let's say you have completed your investment horizon in the fund has completed the roll down, the fund is implementing a new strategy. Let's say at that point of time you are not in need of funds, you want to continue with the investment, you can stay invested in the new strategy if you are aligned to the new strategy. So what really matters when looking at a roll down fund is the communication from the fund house, the communication from the scheme that, okay, this is a strategy that the fund is following, and the consistency in that strategy. So if you see that the fund manager or the scheme is deviating from the stated strategy in the roll down, you can then one has to reassess their allocation towards the scheme. So that's something which needs to be kept in mind in a roll down, which is not necessary to in an index fund, because that that by statutory obligations, the fund is required to invest in that index proportion at all points of time.
Thanks, Anurag, for such a detailed explanation. Though it's time, but if it is okay, we can take a couple of questions. So this question is, there is a significant increase in the credit growth rate. Is this growth collaborated to increase in the business activity? In recent data readings, GST invoicing has reduced on month basis. Also, is this credit growth across all constituents of borrowers?
Thanks for the question. So the high credit growth is due to a couple of reasons. One is the increase in economic activity. So like I said, the services sector has fully reopened in the last 6 to 8 months, right? So even till I would say Jan, Feb of this calendar year, we were experiencing a third wave, and hence the reopening has been slightly tentative. So the full reopening led credit demand has picked up in the last 6 months. The second reason is high nominal GDP growth because of high WPI as well as CPI inflation. So because of high WPI inflation, the prices of inventory or raw material also goes up, and hence any business requires more nominal amount to hold the same inventory compared to last year. So for inflation as well, one is borrowers are looking to borrow more. The third reason possibly is, especially maybe in the first 4 or 5 months, as dollar funding or the capital market funding has become more expensive. Possibly some corporates are also looking to borrow through the banking channel, which has also led to high demand of credit from the banking system. In terms of, I think, overall proportion of borrowers which are looking to borrow, I think right now it's across retail as well as corporates. Although within the corporates, large corporates in the last 2 or 3 years have been deleveraging. Apart from, of course, there are some sector specific, like road sector, renewable sector, power sector, where there has been demand from large corporates. But so far, majority of the disbursements have come from specific projects or SMEs or retail lending.
Moving on to the next question. Recently, we had seen some FII selling in the debt market when the news saying India's bonds will have to wait longer for global index inclusions for reasons of limited liquidity, settlement issues, and unfavorable taxation. Is it true that government is not keen on India's inclusion in global bond indices in a hurry? Your views on the same.
So we can't second guess the government. We don't know whether the government wants or does not want to be included, India to be included in the global bond index. What we know is that the index provider has been actively considering to include India in the emerging market debt indices, and taxation, which is the withholding tax aspect, has been one of the issues, as the finance ministry has stated on various platforms. Uh, they want, uh, and rightfully so, the right to tax at a sovereign level, and they are looking to engage at G20 level uh, through various forums to kind of resolve this issue of double taxation and tax avoidance, etc. So probably there are countries which the index provider has included uh, despite various settlement and other operational challenges. So I think it's a matter of time whether India decides to modify some of its taxation as an operational issue, or whether the index provider. So like I said, we can't second guess either the index provider or the government of India. So they both have their challenges which are well known in the public domain. So any flexibility from either of the sides can lead to that bond index inclusion.
Yeah. So the last question for the session that we can take up, though we have a lot of questions lined up, but considering its time, just one more question. So it is forex reserves is believed to be a key ingredient in building an investment thesis, and rising and falling forex reserves are considered to reflect the preference of foreign investors to an economy. Does forex cover provide a cushion against macro headwinds? What does it mean for the investors?
So it doesn't. So yes, it's a good question, but I think from a fixed income investing standpoint, it doesn't change the view of a terminal rate of firstly 6.5, which is predicated on inflation and a certain macro stability in India. Secondly, I think a lot of focus has gone to just the absolute change of forex reserves. One should, I think, divide the decline or increase in forex reserves to two aspects. One is the valuation aspect, because as we know, most of the countries hold their FX reserves in various currencies, right? It's not just dollars, it's gold, it's euro, pound, yen, etc. So I think if you look at even India's forex reserve, a large part of decline in India's FX reserve is due to revaluation of non-dollar holdings and depreciation in those, rather than just currency intervention and outflows. I think the bigger challenge for and why FX reserve is a reflection is, I think, a stable current account deficit, right? And and like we explained in one of our earlier slides, we think the current account deficit has largely peaked in Q2 of FY23, and from here on, because of seasonality and assuming stability in commodity prices, we think current account deficit from here on should kind of normalize, and it should be largely in line with RBI's expectations. Thank you.
Thanks, Anurag. Participants, do not forget to share your feedback on the link provided below. Anurag, would you like to share any closing comments, and then we may conclude the call?
Sure. I just want to express my thanks to all listeners on this webinar. Please provide your feedback, and you can reach out to your relationship manager at UTI, or post questions to us, and we will be happy to address any of them. Just have a good evening, and thanks again for joining in the call. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.